We're starting with Chapter 6, and we're still in current assets. The textbook follows current assets, long-term assets, liabilities, stockholders' equity. So we are in inventory, and associated with inventory is the cost of goods sold. Notice we're going to skip Objective 6.6. We're going to pick up some details here in Objective 6.1 about what goes into or does not go into inventory cost. The first obvious one is the purchase price of the item. So if you have a computer store or an Apple store and you buy the iPads in at $200 a piece, that's your purchase price. If there are returns and allowances, those would be reductions. Purchase discounts, those would also be reductions, but shipping would be a plus. So shipping is a cost that gets transferred into the inventory cost. So it's good to think of as accounting students that cost does not necessarily equal an expense. The shipping cost will go into inventory and it will get expensed as cost of goods sold. Alright, cost of goods sold is an expense. So the cost will be in this inventory number here. And then when we transfer the inventory to the customer, then we transfer that inventory cost to the expense account, which shows that the inventory is being used up. Okay? And that's what an expense is. It's a using up of a resource or the assumption of a liability. So, so that's inventory cost, and this is the general entry for cost of goods sold. But with the inventory cost or the cost of goods sold, or inventory expense, the cost of goods sold, we're going to see that it's not quite clear which costs we should include in there. For example, in this inventory schedule, you have the units you begin with was 100, you buy 220, and then later you buy 80. So during the month, you had 400 units available for sale. And you sold 150. And 250 were remaining. So remaining units, ending balance is remaining. The first layer, this 100, is at $5 a piece. So it's the first layer, the beginning balance, we call these inventory layers, is 500. The second one is 1,320. And the third layer is $560. So you may notice we have these moving prices. The prices are all the same, it really wouldn't matter very much. But we're also increasing so we can kind of see the effect of our inventory choices, accounting choices on cost of goods sold. Now notice that the dollar per unit and the cost of the item sold during the month and the dollar per unit remaining in inventory and the dollar per unit the total cost of everything remaining in inventory isn't there, because those question marks depend upon which accounting, which cost of goods sold or inventory method we use. All right. Before we get to the particular inventory methods, there's one thing I really want to emphasize, because students, sometimes beginning students get sales confused with inventory expenditures, or inventory expensing. The sale is separate from the cost of goods sold. The sale is what the customer gives you. This is customer consideration. And the cost of goods sold is what it costs the corporation to acquire the inventory that they transfer to the customer. So if for $1,000 it took the corporation $500 to provide that good, then that would be a $500 margin. So that's why we want to keep these revenue and cost of goods sold separate, so we can keep track of that very important information. What is the spread between what it costs us and what our customer is willing to pay? Now, the one thing they do have in common is timing with the cost of goods sold recognition. So to the extent you sold the inventory that you sold this period or used up was used to generate the revenue, you'd want to recognize both that that cost of goods sold in the period in which the sales revenue generated from it was used up. Okay, so just keep in mind sales entry is going to be the sales entry. The only thing we're going to want to do is look at the sales entry and see how many units we sold during that period, and we'll take that information over to our inventory costing method, which we'll do in the next video.